Hey there, Dave here. So, do you want some extra money to invest with? And I'm not talking about the 2 free stocks or a bonus for opening a new account. I'm talking about extra money that just about every brokerage app will give you just for asking. For example, if you subscribe to Robinhood's upgraded gold plan to see research reports and level 2 stock quotes, they include $1,000 to trade on margin. It's not entirely free. The $5 monthly fee for the gold plan works out to being 5% of $1,000. But if you're paying for gold anyway for the other features, you might as well use the included margin money, right? Or not. This is the first of a 3-part series all about leveraged investing. I'm calling it Get Rich or Die Trying, because that's really what leverage can do to you. It can make you rich, or it can absolutely kill your account balance. It seems like everyone is buying stocks these days. The online brokers say that they've seen record numbers of new accounts opened up since the world kind of shut down. And people aren't just buying stocks, but they're using leverage like margin and options. Even here on YouTube, this popular photography channel spun off a new channel all about making money.
Okay, so the way I turned $1,500 into $62,000 was by trading stock options.
Real estate investors are going in big on the stock market.
I bought Tesla like crazy. I bought Apple. I bought Redfin. I bought Amazon. I went nuts buying stocks.
I don't know what this guy normally does, but right now he's trying his hand at trading options.
This is something I've never thoroughly looked into or truly grasped, but I've definitely heard about it from a certain subreddit.
So is using leverage like margin and options too risky?
Margin trading is the devil, okay? Margin trading, I have no business using that crap.
Okay, but is there a way to harness the power of leverage and not get into trouble?
Margin is toxic. It's like the worst thing you could do to your psychology.
Let's begin at the beginning. What exactly is leverage? According to the internet and Robinhood, leverage is an investment strategy of using borrowed capital to increase the potential return on an investment. They say people can use leverage to amplify potential gains, though also potential losses from an investment plan. I'm going to cover the 3 most common types of using leverage for investing: margin, options, and leveraged ETFs. So if you like making money and you like the idea of turbocharging the way your money works for you, here's how to start. Hit the like button. That immediately will double your brokerage account buying power overnight. Not really, but I don't make videos that often, and every like this video gets really does help more people discover it, and I really would appreciate that. Using leverage really does turbocharge your investing dollars, but with the possibility of bigger profits comes way bigger risk. Even if you're familiar with the concepts, even if you already use them in your everyday investing, I think you will get something out of this video. And if you're brand new to the whole idea of leverage, I'm going to do my best to explain everything in a way that just makes sense. You don't need a degree in finance to put these concepts to use, but you do need to know what you're doing. My name's Dave Hanson. I don't have a degree in finance. This is not financial advice. It's just a YouTube video from a guy on the internet, so take that for what it's worth. But I have been using leveraged investments since I discovered options. Subscribe, and someday I'll tell you the story of how when I was 23 years old, I somehow managed to lose 5 times my annual salary by trading options. Do as I say, not as I did. There are 3 main types of leveraged investing. I'd say on a scale from least to most amount of leverage, it's margin, then leveraged ETFs, then options. That's generally the scale of risk too, but not completely. This is going to be a 3-parter, so if you're not yet a subscriber, you should do that now. Turn on notifications. I'm really the worst YouTuber, at least as far as the algorithm is concerned, because I am not cranking out content every day on this channel. When I do, people seem to like it, and I thank you all for all of the comments. I read every single one and respond to as many as I can. Today I'll cover using margin, which is essentially borrowing money from the brokerage company to be able to buy more stock. It's kind of like having a mortgage loan to buy a more expensive house than you could afford using cash. With margin, they use the value of the stocks and cash in your account to determine just how much you can borrow. And as with any loan, they charge you interest on the money that you're borrowing. Before we go any further, I do want to talk for a minute about how I find investment ideas, because if you follow my investments, you know that the only time I go all in with a highly leveraged trade is when I think I found a new trend or some change in consumer behavior that hasn't yet been discovered by the pros on Wall Street, something that the old school business news isn't going to pick up on for weeks or months. Which makes this the perfect time to introduce the sponsor of today's video, Trends by The Hustle. Trends is an amazing community built for entrepreneurs, investors, people like us, where we can network, bounce ideas around, and uncover potential trends before they happen. I just recently joined the Trends community, and it's blown me away so far. The quality of the people, their weekly live lecture events. For me, I could spend days just browsing the beautiful graphical summaries of what's trending online. If you want to check it out and take a look around for yourself, right now you can get your first 2 weeks for just $1. Go to trends.co/Dave for your $1 2-week trial. Once you're in, come find me, say hi. I'm in the private Facebook group, trends.co/Dave. Try it. Link in the description. And thanks to The Hustle and Trends for sponsoring today's video. I'm starting the series with margin because it is the one thing that I think most people go to first. Most brokerages make it so easy to access. Robinhood gives you that $1,000 of margin when you sign up for their gold plan. All the brokerages make it super easy. But with all the dire warnings about margin, when and why would you actually want to use it? To me, it's a simple math question. If you think a stock or whatever investment is going to go up faster than whatever interest rate you're paying to borrow that money, using margin seems to make sense. But it's not quite that simple. You can get into trouble very quickly if the stock doesn't go up the way you're expecting. Remember, you have to pay the interest regardless of what the stock price does, and margin rates can vary wildly between brokerages. Sometimes that rate can change depending on how much you borrow. They'll usually lower the interest rate when you borrow more money. For example, the published margin interest rates to borrow up to $10,000 at the old school online brokers like TD, Schwab, and E-Trade, as of right now when I'm filming this, are all in the 8 to 10% range. Think about that. Your investments have to go up that much just to break even. I know what they say,
you go gong, and stocks go up.
but stonks don't always just go up.
Let's go.
Yes, on average, over long periods of time, they do, or at least they have since the beginning of the stock market. The S&P 500's average return over the past 90 years is just under 10% per year. But to me, borrowing money to just be average with your investments is a terrible idea. I mean, it's great for the brokerage. They get paid regardless of what your investment does. There are lower margin rates out there. Robinhood is essentially 5%. M1 Finance advertises rates as low as 2% if you subscribe to their Plus account. Interactive Brokers advertises rates as low as 0.75%, but you have to borrow a ton of money to actually get that rate. For normal people, it's more like 1.5% to 2.5%. So I did the math. To get down to an effective rate of 0.75%, it looks like you have to borrow $800 million. Okay, maybe someday. But even if you are sure that your stock is going to go up and the margin rate makes sense, what happens if you're wrong? Well, if the stock price drops, you might trigger a nasty little thing called a margin call. That means they call your loan. You have to send them cash to repay the amount you're borrowing, or they're going to sell your stocks to cover the loan. Margin is regulated by both the New York Stock Exchange and by FINRA, the Financial Industry Regulatory Authority, and they say that you have to keep at least 25% of the total value of stocks in your margin account. Basically, that means if you have $1,000 of stock in your account, you can borrow up to $3,000 and then have $4,000 worth of stock in your account. But if the stock price goes down, even to say $3,999, you no longer have enough equity and you've triggered a margin call. If you like math, you can pause and understand how this is calculated. And this is a simplified example. There are other regulations like the SEC's Reg T, and brokers have their own rules around concentration in a single stock that wouldn't exactly allow this example to work if you were, say, starting with $1,000 of cash, or you were only buying a bunch of the same stock. The important takeaway is that if the stock price drops and you no longer meet the minimum threshold, you either have to send them more cash or they sell your stock. That makes it super important to understand what you're doing with your money, and generally your broker's not even going to let you go outside of the boundaries unless they have a glitch, like the infamous Robinhood infinite money glitch last year.
The margin account loophole where you could have unlimited investing funds.
It does not instill confidence, to be honest, in Robinhood.
Also, that 25% is the absolute minimum amount legally allowed. Most brokerages have higher requirements, and it usually varies based on what you're buying with the money that you borrow. Stocks that have big swings have a higher maintenance requirement. Some stocks aren't marginable at all, meaning they have a 100% maintenance requirement. The scariest thing about margin to me is that the broker can change the rules at any time. They can just decide they want to arbitrarily change the maintenance requirement without notice. And if you don't have the cash to cover, they jump in and sell your stocks. So buyer beware, read as much of the fine print on their website as you can possibly tolerate, and ask them if you don't understand how it works. I personally use margin fairly frequently, despite all the warnings. The reason I use margin is simple. I try to keep my portfolio fully invested in the stock market at all times, because there are tons of studies that show that in the long run, you come out ahead by being fully invested instead of just jumping in and out and trying to time the market. That's why professional money managers have such a hard time beating the S&P 500. But for me, in addition to long-term stocks and ETFs that I buy and hold, I like to have a little fun. Being completely passive is boring. If you watch Dumb Money, you know that I'm the pragmatic one. I don't make every crazy trade that we find, but when I have high conviction, I go in big. But since I try to stay fully invested and I don't want to sell my existing stocks and have to pay capital gains taxes, using margin makes sense. And I don't go crazy as a percentage of my portfolio. A big speculative trade for me might be $500,000, which is definitely less than 10% of my main brokerage account. I know the interest is expensive. I think the margin rate on that account is around 6.5%. And if I did this more often, I would negotiate a lower rate. But like I said, I don't do it often enough or keep a margin balance for long enough to really have much negotiating power. Even at 6.5%, the interest ends up being around $3,000 a month, and that's on a $500,000 high conviction trade. And if I thought that the gain on that kind of a trade wasn't going to far surpass the $3,000 of interest, it would have never qualified as being high conviction in the first place. $3,000 of interest is just a cost of doing business, and margin interest can be deductible on your taxes too. Deductible expenses are my favorite kind of expenses. I know those numbers sound high and might seem completely unrealistic for your situation, but the exact same principles apply if you just take off a few zeros. The whole reason I make these videos is to help you understand how things work and how you can apply it to your own life, and hopefully someday you'll be even better at this than I am. And I'll tell you, watching your money grow and making a few big trades a year in the stock market is way better than any job. I started trading stocks and learning and making money and losing money long before I had a real job, and then once I did have a real job, I took the money I made from working and I invested it. And now investing makes me more money than I ever did as a salary working every day. But the only way to get good and confident in what you're doing is by doing it. Start with paper trading on sites like Thinkorswim. Or better yet, open a brokerage account and just start building your account balance over time with whatever you can afford. I like to invest in a low-fee S&P 500 ETF because even professional money managers are rarely able to outperform the S&P 500 over time. My all-time favorite ticker symbol is VOO, which is the Vanguard S&P 500 ETF. I like that one because it's a low expense ratio and it is tied to the index that money managers and actively managed funds try to beat, and usually fail. If you're like me, you immediately think, should I use margin to buy even more of the S&P 500 than I could afford to buy with cash? Well, think about it. We know that the all-time average performance there is around 10% per year. So do the math. You're paying interest regardless of whether the market goes up or down. You know that the interest rate will be somewhere between 2 and 10%, but the risk is that the market doesn't always go up, and we saw that quite dramatically earlier this year.
Markets in free fall this morning.
But for me, if I were ever considering using margin to buy an index fund like the VOO, knowing that the all-time historical average of the S&P is 10%, I wouldn't want to pay the interest. And having just lived through a 30% drop in 30 days, I would not want to take on the risk of a margin call. And that perfectly brings me to the second form of leveraged investing, leveraged ETFs. And that will be the topic of my next video. So please do subscribe if you're not already, turn on notifications. Even I have no idea when I'm going to post a video here. Also, do head to trends.co/Dave for a $1 2-week trial. Thanks to The Hustle for sponsoring this video. And thank you all so much for watching. Do let me know in the comments that you did stick around until the very end by telling me the one company or ETF that you would be most likely to use leverage to buy. #LeveragePick. I'll pick a few of you guys at random, send you some free merch, and by the way, if part 2 is available, I'm going to link to it here. If not, just watch whatever is here because YouTube picked it just for you. They think you're going to like it. My name's Dave Hanson. I will see you in the next one.